Hey, what's up guys? Thanks for tuning back in, and if you're new, make sure you hit that subscribe button so that way you can check out weekly posts on personal wealth management and market insights. My name is Ash, certified financial planner, bringing you the knowledge, perspective, and resources from my world to help you live a better financial life. Today's video is inspired by a couple of my really close friends who are out here popping out babies like some Skittles. Congratulations to all you new baby owners, aka parents, aka bro dads, aka you ain't gonna make it to bottomless mimosas anytime soon. Such a blessing to be a parent, and I'm so happy for you all. So today's video is on college savings. You all know how expensive college can be, and statistically speaking, the cost of college has doubled every 9 years since the 1980s. So for all you parents and grandparents, it's super important to get started early. In this video, I'm going to break down several tax advantage ways that you can save for college. Whether it's for your child, grandbaby, niece, or nephew, these methods can definitely be an option for you. Let's start with the 529 savings plan. This account is tax advantaged, meaning that any growth, dividends, and interest you have on your principal, you do not pay taxes on annually. As a matter of fact, for any qualified educational expenses, you don't have to pay any taxes. Here is an example of how a 529 plan works. Let's say that you deposit $10,000 for your little boy Johnny, and you don't make any other contributions. And in 18 years, that grows to $40,000, which by the way is realistic because that averages out to about an 8% year-over-year return. After the 18 years, you don't have to pay any taxes on that $40,000 balance if you use it for qualified educational purposes. If you use it for anything else, like a down payment on a car for Johnny, that's not an educational expense, therefore will be subject to taxes and penalties by the IRS. The investment options within a 529 plan are limited and preset, which means that you cannot make individual stock or ETF selections within them, but you can select how aggressive or conservative you want to be for the account. Or you can simply select a time frame option, which starts off more growth oriented in the beginning, gradually gets more conservative as the child reaches the age of 18. This ultimately makes these accounts really low maintenance and easy to manage. Here are some additional features and facts of 529 plans. You can utilize them for K through 12 and higher education. Next, depending on which state you live in, you may be able to reap tax deductions for your contributions. For a list of states, there is a link in the description below. Also, you can change the beneficiaries. So for example, if you started a 529 plan for Johnny, but he ended up getting a full ride scholarship to UCLA, you can change the beneficiary of the 529 account to another sibling or family member. Lastly, there are annual and lifetime contribution limits to a 529 plan. Annual contribution limits are subject to the gift tax rules. So it is limited to $15,000 per individual who is looking to make a contribution. So both mom and dad can do a combined $30,000 a year. And if grandma and grandpa want to add to that, they can both do $15,000 each. Also, one thing to note, there are max contribution limits per beneficiary, which basically means that a certain beneficiary cannot exceed a certain amount of 529 contributions. Each state has their own max limit, but they average around $400,000 or so, which does not include the growth. So keep that in mind if you're balling out of control. Next, another way you can save for college and child expenses is through a custodial brokerage account. This is basically a normal investment account, but instead of the parent or guardian as the owner, the child is. But the child, while they are a minor, has no access to the account. However, the custodian helps manage the account until the child becomes of age. So the custodian will select the stocks or ETFs or make any withdrawals from the account if necessary. The age when the minor takes over the account is age 18. In some states, 21. And when the minor reaches that age, they are 100% sole owners of the account and they could do whatever they want with the money. Next, in regards to taxes, the custodial account is not tax advantaged like a 529 plan, but any growth, dividends, and interest are most likely not taxable until you reach a $2,200 threshold in a given tax year, which still makes the custodial account pretty advantageous. There are some cases, however, where the gains, interest, and dividends can be taxable under the parent's taxable bracket, but it's kind of rare. I have the IRS link for the kitty tax in the description below for your reference. Lastly, money within a custodial account can be used for any purpose. It can be withdrawn anytime without penalty and without any restrictions. So the funds can be used on Johnny's new car, his vacations, or even expenses for launching his YouTube channel. And custodial brokerage accounts are a great alternative to normal savings that just sit in cash. These accounts allow you to take the money from birthdays, summer jobs, graduations, and empower them to invest at an early age. And it enables you to buy great long-term plays like Disney, Nike, Amazon. And when your kids get to a certain age, you'll be able to show them that they own shares of their favorite companies. Like I wish someone would have bought me shares of Tesla when it was like $20. But anyways, unlike the 529 plan, there is no max account contribution limit per beneficiary. However, the contribution amounts are still subject to the gift tax rules and the same $15,000 limit per individual who is making that contribution. So to highlight the key differences, I made this graph for you guys. And a very common question that I get from all you parents is, Which one is better? Well, as you can see from my handy dandy graph, they both have their pros and cons. And you're seeing all that red next to the 529, so you're probably thinking the custodial must be better, right? No, you're wrong. Sorry, that was really aggressive. I didn't mean that. But while it may seem that the 529 has too many disadvantages, I actually like that one a little bit more, and it's because of the tax-free growth potential. But why do one when you can actually utilize both? My 2 cents is open both accounts and take advantage of the full spectrum. Wow. Depending on how much you want to save for the child, I would definitely consider weighing more of your contributions towards the 529 savings plan. And what I like is the 80-20 rule. It's a rule that I created that many clients found that worked for them, and hopefully it does for you. Let me show you how it works. Let's say you want to save $500 a month for your child. Well, with the 80-20 rule, 80% of that amount would go into the 529 plan, and the remaining 20% would go into the custodial account. You're of course still saving the same amount of $500, but you're positioning it to take advantage of both account features. And you're preparing yourself for both educational and non-educational expenses. Why gear more towards the 529 account? College is expensive as and it isn't getting any cheaper. Plus, if you remember from earlier, the minor becomes the sole owner of the custodial account once they reach the age of 18. So I prefer not giving my 18-year-old access to thousands of dollars that they can spend on whatever they want. Actually, now that I think about it, I'm kind of glad no one bought me Apple or Tesla like $20 a share. Champagne for everyone! I hope this gave you all a good overview of the ways you can save for college, so be sure to like this video to support the channel and share it to those that you think might find this information useful. I appreciate you all tapping in. My name is Ash. I'll catch you guys next time.